right, so on a, moi je vais le faire en français, je vais peut-être leur switcher en anglais aussi. Mes collègues, ça va être, obviously in English. Donc on va faire un retour, qu'est-ce que le Congrès a de l'air présentement, où ça s'en va. On va quand même assez dans le détail là-dessus. On va aussi au niveau des projets de loi qui sont au Congrès présentement et qui sont comme pris. Donc, on n'est pas certain qu'il y ait des choses qui vont arriver, mais on va en parler. Ensuite, 2 sujets qui, moi, me tiennent à cœur beaucoup, que j'ai parlé à beaucoup de clients dans les dernières années. Tous les enjeux au niveau des dépenses de recherche et développement aux États-Unis et aussi tout ce qui a rapport un peu avec nos règles de high-fall à nous qui existent depuis 2017, en fait. Donc, bravo le Canada de faire quelque chose comme 7 ans par la suite. Donc, on va parler des règles au niveau de la limitation de déductibilité de l'intérêt. On va aborder un peu comme Monique avait mentionné tantôt, Pillar 2, mais à saveur américaine, qui est un peu le point de vue américain là-dessus. Vous allez voir, c'est quand même intéressant. On va parler aussi beaucoup, par exemple, si on a de la clientèle ici avec une maison mère américaine ou une filiale américaine, le type de questions, le type d'interaction qu'il peut avoir entre les deux. Pourquoi il me pose ces questions-là? Pourquoi on rentre là-dedans un peu? Et un autre sujet, encore une fois, ça fait quelques années que je mentionne à mes clients, beaucoup plus d'activités au niveau des vérifications de par l'IRS. On en voit beaucoup plus, plus de questions, puis juste faire réaliser aux gens aussi ce qui est le nouveau financement qu'il y a auprès de l'IRS, les trucs qu'ils regardent maintenant de façon systématique lorsqu'ils font une vérification. Donc, on en voit beaucoup plus. Puis, à date, ça va quand même bien. C'est des gens raisonnables. Mais il y a une grande différence, en fait, je vous dirais, par rapport aux 10 dernières années, où souvent, ce que j'entendais de ma clientèle, c'est « Ah, on va Revenu Canada aux 3 ans, puis l'IRS, j'ai jamais vu la couleur de ça, puis ça fait 20 ans qu'on est aux États-Unis. » Il y a des gros risques que ça change dans les prochaines années. Legislative update. That's you,
Yes.
Cory.
Yes.
All right.
Thanks for that intro.
All right.
It sounded great. I have no idea what that All right. So we're going to
Did everybody introduce themselves, or I skipped that kind? All right. I'm a bad host. So. Cory Perry from our Washington National Tax Office, which I deal with a bunch of time. So if you got like really crunchy questions, which I don't know the answer, this is the guy that I call. Right. And Keith Nichols, who's in charge of everything that's like credit and incentive as far as research, development, that sort of thing in the U.S. So somebody that I, deal with a lot, either through controversy or bringing the good words to our client about what has happened with tout ce qui est recherche et développement aux États-Unis dans les dernières années. Puis il y a eu beaucoup de changements, comme il va vous expliquer. Donc, Cory, back to you.
All right. Thank you. So we're going to keep it political light, but we did want to start with the legislative update and talk a little bit about where tax policy is going in the United States and the different directions it could take based on how the elections turn out this year. So 2023 in the U.S. was a very slow year. We were talking about this at dinner last night. It was actually broke the record for the least amount of bills enacted in the United States in a single year. So I think the number was 23, very, very low activity for the United States. So we didn't really have any meaningful legislative tax policy last year. We started off 2024 with some hopeful movement of a tax bill. That was the extenders bill. In the US, we have a lot of provisions for a variety of reasons. So bills that will extend some of the benefits that are included in the package, and it has to do with mechanics of the way that the U.S. Political process and legislative process works. So we had a deal between the four corners, which is the leaders of both the House and the Senate, although only two had fully signed on to the deal, extending some of the major provisions, mostly related to Tax Cuts and Jobs Act, but a few others that are very favorable business items. The bonus depreciation, that's our expensing provision. So instead of depreciating, you can fully expense some types of property. That went down from 100 to 80%, and it's going to scale down more. They would be extending that and continuing it at 100% for 2023. There's a 163J, which is our interest limitation, kind of like the BEPS interest limitation. If there's certain adjusted taxable income, there's a limit on that as to the amount of interest deduction you can take. That changed from EBITDA to EBIT, which was a very taxpayer unfavorable change and further restricted taxpayers' ability to take interest deduction. So in this extenders bill, they would potentially restore the ability to use EBITDA as opposed to EBIT and retroactively back to 2022. We'll come back to the retroactivity, but that's a little unusual in U.S. tax law. In addition to that, it has some 174 provisions. Keith, I don't know if you want to touch on those.
Yeah, the thought is, which hit a lot of taxpayers, is reverting back to being able to deduct currently research experimental cost as opposed to having to capitalize 22 and forward. So we'll dig into more of that in the 174 section, but that's a big, and that's retroactive as well.
Yep, and that hit taxpayers hard. Certain taxpayers may have never been in taxable income as a result of this capitalization, may have put them in taxable income for a first time. So this would restore some of that retroactively back to 2022. This bill had early momentum coming into 2024. It passed the House 357 to 70. That's bipartisan, a little bit unusual in U.S. politics. And all signs pointed to it quickly passing through the Senate, but it's recently stalled out pretty significantly. Mike Crapo, who's the Republican ranking chair of the Senate Finance Committee, has raised a number of issues associated with it. There's a child tax credit look-back piece they're not so happy with. But I think most importantly is probably the political element from the Republican Party. It would be seen as a potential win for Biden and the Democrats if they pass a bill now, even though this is a bill that they would traditionally be in favor of, that is inclusive of a number of what could be considered tax cuts. The other piece that's a little bit interesting about this, and I touched on this on the last slide, is that it's retroactive to 2022. And we don't have many retroactive bills in the United States. And the idea behind some of these incentives, like the bonus depreciation incentive, is to encourage U.S. companies to invest in additional purchases, right? That's the tax policy behind giving full expensing, is to incentivize purchases. Well, if you're doing that retroactively, are you really incentivizing any behavior? So that's come up through the political process as well, which has really slowed this bill down, which is unfortunate because it includes a number of provisions that are very business favorable, that are causing a number of concerns amongst our client base. In addition to that, the retroactivity, not going to drill down into this too much, but it creates an interesting outcome here because some taxpayers have filed a return. Some may have even filed 2 returns by the time this bill passes, if it does pass. And if it does pass, they would need to effectively either amend returns to claim some of the benefit that's included in here, or in some cases, there's ability to do method changes on a more prospective basis. But it would create some interesting interactions here because generally U.S. tax law changes are going to be prospective, which means you can include it in your current return forward. This could be impacting 2 previously filed returns. So I think I had one more on that just before we move off. If it does pass, I think the time frame would be around April 15th is what we're hearing. The reason, really what we think is going to happen potentially here is either a deal will be reached on or around that time and they'll put it forward and they know they'll have the votes, or they'll put it forward The Democrats will put it forward knowing they don't have the votes just to let the Republicans effectively vote it down. So we'll probably see something around the April 15th timeframe, and at that point we'll hopefully know whether there's any potential for those.
Cory, real quick,
Yeah.
on the 174 front, so being retroactive to 22, taxpayers could file a method change as part of their 23 return, and you would have a favorable adjustment, a 41A adjustment for that unamortized balance from 22 to 23. So that's one way that you would affect the retroactivity.
Yeah.
So is that done like in a vacuum? Like, because 174, right, would bleed into, for example, how, you know, guilty was available or other provision in 2022? Are we just changing 174 there and not looking at how it would have applied back to 2022, right? If I would do like a full amendment, like for example 163J or whatever, it, like, you know, as
You
you know,
redo your whole return.
you got to redo the whole return, and everything, you know, touches on everything. So that's like on the,
This is
the method
reflecting
change. Yeah.
just the 170, if you do a method change for 174.
Okay.
So it would be just prospective. You wouldn't go back and undo those changes.
Right.
Parce que c'est ce bout-là que, avec la rétroactivité comme préparateur, qu'on trouve vraiment lourd, en fait, c'est que là, il faut faire un choix. Est-ce que je fais juste un changement de méthode comptable pour 2022 que j'applique à 2023 puis qui impacte mon revenu imposable en 2023? Ou est-ce que je reviens puis j'amende 2022? Puis n'importe lequel de ces changements-là, en fait, va avoir un impact sur d'autres déductions, par exemple, d'autres items dans ta déclaration. C'est ça qui vient extrêmement difficile. Fait que, en tout cas, moi, personnellement, au niveau de la rétroactivité, s'ils peuvent faire 100, c'est OK pour moi, là, mais il y a vraiment une complexité par rapport à cette rétroactivité-là parce qu'il y a quelque chose qui change, mais ça va avoir un impact sur d'autres items qui sont sur la déclaration d'impôt.
So looking forward, so that's where we are now with the current tax bills. And the next couple slides, I'm going to focus on what tax policy might look like in a couple years from now, because there is potential for some significant change in the short term. We have some pretty significant parts of the Tax Cuts and Jobs Act, that was the Trump and the Republican bill from 2017, that are expiring in 2025, the end of 2025, so effectively in 2026. Those are all the individual tax cuts and a number of the business favorable pieces. The GILTI tax deduction ramps up. The FDII deduction, which is like an export incentive, ramps up. The BEAT rate, which is the base erosion tax, that negatively goes up as well. A number of other items that are set to expire around that time. So that will create an opportunity potentially for some potential tax reform and maybe some bipartisan type activity, because there's going to be pieces on both the Democrat and Republican side, but that of course remains to be seen. So I thought I'd just quickly cover the outlook of the elections, which I think will set the stage for some of this, and it's sort of a very interesting election year for us. In the Senate, the House has, or excuse me, the Senate, there's 23 seats that the Democrats have to defend this year. That's a lot of seats, and the only pickups they have are potentially in Texas and Florida. They currently have the majority in the Senate, but they could very easily lose this because the GOP has only 10 seats to defend, and they have pickup potentials in a couple states like West Virginia. Joe Manchin, a very centrist Democrat, is retiring, and other seats are up where they could potentially pick up seats. In the House, it's actually leaning the other way, where it looks like the Democrats might pick up seats, and we could see something that's never happened before, where the House and the Senate actually flip. Currently, the Democrats control the Senate. The House is controlled by the Republicans, which creates a split government, which is the reason we had nothing done in 2023 for a lot of reasons. This could actually flip that, which has never happened before. And then, of course, we have the presidential election. I'm not going to touch that, but that could go either way. We'll see what happens there. So we have a couple different scenarios we could see. We could see a full sweep by the Democrats, where they take the House, they take the House, they maintain the Senate, they maintain the presidency. If we have a unified Democratic government, I believe in 2026 we'll have some pretty significant tax reform in the United States. Joe Biden tried to push some of this through in 2022 and wasn't successful, but that would be all the Pillar 2 initiatives and a number of other international tax reforms. So if we do see that, probably unlikely, but if we do see that, we'll see some pretty significant tax reform aligning with many of the OECD policies in 2020. Probably 2025 or 2026. If it goes the other way and it's a complete sweep by the Republicans and they have full control, we are likely to see the Tax Cuts and Jobs Act sort of 2.0 in 2026, where they extend all those provisions and probably add on to them as far as some of the business incentives and tax cuts, whereas the Democrats are leading towards tax increases in many cases. More likely, and I think the potential outcome here is we end in the middle with a split in one of those three areas, and in which case we'll probably have gridlock and at best maybe some small bipartisan bills over the next couple of years. So we'll find out by the end of this year, but there's potential for a lot. More likely we'll end up somewhere in the middle where we've been for the past couple of years with very little overall tax activity. All right, so we're going to change gears now and talk a little bit about the R&D credit.
Thank you, Cory.
You're welcome.
Hello, everyone. R&D credits. I'm going to start there. There we go. So just a bit of basic background. So the credit, it's a 14% gross credit in the U.S. It's primarily driven by qualified wages, qualified supply cost, and contract research. It is a permanent tax benefit in the U.S., and it carries forward 20 years. So that's kind of the basics. So why are we talking about the R&D credit? The level of effort continues to increase from a compliance standpoint in the U.S. In other words, and we'll get into it in the next couple of slides, but being able to document positions down to, I'm going to use the term business component. I'll use the term business component. In other words, project, having to really document down to the project level is creating a lot of additional burden, along with some, I'll say, more compliance type procedures as well. So, number one, for taxpayers who are claiming credits on a amended return, so you're claiming a refund, the IRS put in place a set of procedures that instead of just amending your return, which generally is a fairly straightforward process, now taxpayers have to attach quite a bit of detail to document that the claim is valid. So they have to provide documentation for every business component or project, kind of why it qualifies. They have to define what each employee was performing from a qualified perspective. And they have to provide a list of all employees who are part of the refund claim. That is a good amount of additional work that is now required if you're going to claim credits on amended refund claim returns. And that's something that IRS put in place beginning in 22, and it's being very inconsistently applied. And so what's a valid claim? There's a processing center in Utah that makes the determination. They send out a letter if they think you haven't provided enough. They give you 45 days to respond to try to perfect the claim, and at that point either accept or reject the claim. If they reject, at that point, haven't went through examination, so there's really no appeals process. The only other process to dispute would potentially be to file suit in district court. So there's a lot of uncertainty in terms of for taxpayers that get denied as part of this procedure, what do you do? So it's evidence that IRS continues to focus on the R&D credit area. This example relates to refund claims. This next example is not in effect yet, but a lot of discussion with IRS national office around increasing what has to be filed with an original return. So right now, you see the form 6765. That's the form that you report the credit on. Essentially, it's those three types of qualified cost and then running it through the mechanics of the computation. Where IRS appears to be going is similar to those refund claim requirements, having to attach why each project qualifies. We refer to that as the 4-part test. What the qualified expenses are in detail, and then again a breakout of all the qualified wages and what services those employees are performing. That's proposed. It's not clear when and if IRS may move forward on that, but clearly when we see what they've done from a refund claim standpoint, it is likely in the next few years they'll require that same kind of detail to be filed with the originally filed return as well. So in that light, that's why we wanted to talk about this, because in the US, the level of effort to document, report, and ultimately defend your claim and examination really continues to increase. So that's R&D credit. Let's talk about Section 174. And this has been the big change that's affected a lot of taxpayers in the last couple of years. So prior to what we call the TCJA, or the Tax Cuts and Jobs Act, any Section 174 research and experimental costs were currently deductible, unless the taxpayer elected something different. There was 2 elections. They could elect to amortize over up to 60 months, or another election under 59E to amortize over 10 years, but those were elective. So for the most part, most of our clients were deducting currently. When, I'll get into the change with TCJA, but just to define what an R&E expenditure is. And so one, it's all cost incurred in connection with your trade or business. All costs incident to means not only wages, supplies, contract research for qualified activities, but it also includes costs incident to. So that's allocations of things like rent and depreciation. Anything that facilitates the ability to conduct that R&D also has to be allocated to Section 174. So with that in mind, then we get to the Tax Cuts and Jobs Act. So what that did is said, any cost identified as Section 174 R&E is now no longer currently deductible. Instead, it has to be capitalized. If it's domestic 174, so performed in the US, then it has to be amortized over 5 years. And if it's outside the US, it has to be amortized over 15 years. So that was a big change for a lot of taxpayers in the technology industry, kind of across the board. And as Cory mentioned, for a number of taxpayers, it actually put them into a taxable income position when they historically had been in a loss position. And so it's hit a lot of companies from that perspective. From a cash flow perspective, a lot of our startups struggled to implement this. Hence, all of the discussion to try to push Congress to defer, at least for a couple of years, the implementation and do it retroactively. So we got initial legislative guidance, really just amending the statute in terms of what is 174, what kind of costs get pulled in. In September, we received the first guidance from IRS and Treasury in the form of a notice. And that notice, and I'll go through some of the more prevalent items in that notice, but it's effective for tax years ending after September 8th, 23. And currently, taxpayers can rely on that guidance, but they're not required to until final regulations are issued. Our best intelligence says that proposed regulations will probably be issued this summer. There'll be a comment period, and so it's not clear exactly when we will get final regulations, but we should get proposed rules, which will likely be pretty similar to the language in the notice. So what kind of costs get pulled into 174? I talked about those direct costs, wages, supplies, contract research for those who are performing the R&E activities. Also, anything, so cost recovery allowances, depreciation on buildings, for example, equipment, the developers use to do their research, that gets pulled in, patent cost, travel cost, anything that facilitates the ability for the developers, engineers, et cetera, to perform the research. What Treasury and IRS did clarify is that particularly that first item, general and administrative costs. So things like accounting and finance and HR, are those facilitative of being able to conduct R&E? It's a tough question. Our position initially was, no, they're too indirect, if you will, but there's really nothing to point to. But IRS in this notice clearly clarified that G&A type costs should not be allocated to 174 and don't get pulled into that capitalization over 5 or 15 years. The other big consideration was interest. Do you allocate interest to the ability to conduct R&E or not? Differing positions there. The notice currently reads that interest is a do not include item. So I'm sure we'll get more guidance of what is excluded, but the notice does provide a good amount of guidance in that respect. So we talked about this concept of having to allocate what we'll call those incident to costs. So not the direct cost, but those that facilitate. And so the notice did provide some guidance that made sense. You're really trying to allocate those kind of costs on a cause and effect basis. So if you're allocating rent or building depreciation, you could do that headcount. So look at your number of developers, engineers who are performing research over a total employee population, use some kind of percentage like that. You could do it on a wage basis. So they've given flexibility in terms of what's a reasonable method to be able to allocate those indirect, or the way 174 refers to them, incident to type costs. The other tricky area here is where you're a service provider. So you're providing service to a customer. If that service is an R&E defined activity, or if it's software development, then do you get pulled into 174 capitalization or not? And that first bullet, I think, is key in that it provides that, so service provider requires a service provider to capitalize its cost incurred under R&E service arrangements or agreements if the service provider has rights to the research or financial risk. So the first test would be, if you're providing the service, if you have financial risk under the arrangement, then you're deemed to have 174 cost. If you do not have risk, but you still have rights, it's an or test. So if you're not at risk from an economic perspective, but you have rights in what you're developing, then the way the notice current reads, you would have to include those related costs under those customer contracts as 174 capitalizable. It's a tricky area. The R&D credit is different in that the R&D credit is an and test. So you have to have economic risk and rights. It appears in that second bullet, what Treasury and IRS are trying to say is that if you have economic risk, then you're really selling a product, you're really selling your intellectual property, if you will. And so they seem to be taking that position. We know the primary drafter at IRS pretty well. I worked with him over the years. We've talked to him about this in terms of how they're applying risk, but it sure seems they're going this direction in terms of an or test. And so more to come there, but that can be tricky for a lot of clients that are providing services, whether it's software development services or other R&E services, and get pulled into 174 capitalization. Another consideration is, so looking at the illustration here, so I've got a Canadian parent. I'll get into the why owning IP is important. So in this example, Canadian parent contracts with U.S. subsidiary under an arrangement. In this case, let's assume a cost plus reimbursable type arrangement. U.S. sub is performing the R&E activities. Again, that could be R&E, it could be software development on behalf of the Canadian parent. And U.S. sub incurs costs to provide those services. So the question is, in what U.S. sub is doing, if they're performing R&E activities, does the sub get pulled into having to capitalize those costs? This gets back fundamentally to that risk and rights discussion. So typically, under a cost plus reimbursement arrangement, the Canadian parent retains the economic risk. In other words, they're paying U.S. sub to do contract research on their behalf. And typically in those arrangements, in this example, Canadian parent will own all the IP as well. So if you go back to that test as a service provider, in this case, sub is a service provider to parent, sub doesn't have economic risk and sub doesn't have rights because the Canadian parent keeps all the rights. So in that example, the way we read the rules, the way the notice lays those rules out, U.S. sub does not treat those costs as 174. And so I think that's a key area to keep in mind when you have those kind of cost plus reimbursement type arrangements. I won't get into it, we could talk later, but cost sharing is something very different, just the way cost sharing operates. But in this arrangement, we think there's not a 174 capitalization obligation. Last couple topics here. So computer software. What the amended statute did was say, not only is 174 capitalizable, but software development is deemed to be 174 on its face. So whether or not it's meeting the 174 regulations, if you're developing software, then it says you have 174 cost. Why they decided to do that, I think it was a revenue raiser, in my opinion, but it does have an impact when you're developing software, whether it's software for sale to customers or if you're developing software internally to run your business. And so the notice starts to define, what is computer software. It notes that any upgrades or enhancements to software would also be pulled in. They point to this material increase in speed or efficiency in terms of what is an upgrade. And again, it's software that's either used in your trade or business or that's sold to customer. Here, if you have software development, then these are the kinds of activities and costs that get pulled in. So essentially, it's your development life cycle. Probably most critically is writing source code. That seems to be a key in terms of whether or not you're developing software. And so that's a tricky area. Again, we can kind of go into that one off where there's questions, but what is computer software is still a little bit ambiguous. The notice does provide what is not. So in the context of developing software, training employees, maintenance activities, data conversion, and then installing software, none of that is deemed to be computer software. And then in the context of selling software to others, any of the maintenance activities, distribution, customer support, that would not be deemed to be software development either in that context. And then finally, from a purchase software perspective, if you purchase software that you're going to use in your business, the notice does provide a position where if you're configuring software, and it uses this term, the configuration of pre-coded parameters. So if you're buying software and you're working within the parameters of that software, so think ERP. If you're staying within the bounds of ERP, Oracle, for example, and you're flipping switches, turning modules on and off, things like that to customize it for your business, that really should not be software development under 174. If you're doing coding or you're having to write code to interface with other systems, that activity likely is 174 and gets hung up in capitalization rules. So software is evolving a tricky area. I think we'll get more guidance, but something that we need to definitely keep in mind. Actually, with that, we've covered the deferral slide. So with that, Cory, I will transition back to you. So
Okay, sounds good. I'm going to try this other mic here.
Yes.
All right. So we're going to talk a little bit next about interest expense and some potential planning opportunities. Because as I discussed at the beginning, there is a very real likely outcome that extender bill will not be passed. And if that's the case, a lot of taxpayers may have challenges in 2022 and going forward with interest deductibility. So in the past, 2018 to 2021, there was much more favorable rules as far as the interest limitation goes. The limitation was it allowed for much more of a deduction. We had the deductibility of 174 during that period, and we had historically low interest rates. So all of those combined, even though we had new interest limitation rules, they really weren't impacting taxpayers as much in those earlier years. 2022 and forward, we now have EBIT instead of EBITDA. So when you're making your adjustments, you reduce your limitation by depreciation and amortization. And we obviously have very high interest rates right now. Single digits in the past, now we're double digits easily in many cases. So a lot more interest and a lot more potential for this limitation applying broadly to taxpayers. So there are some opportunities around and some planning considerations to avoid some of these harsh rules with respect to interest. And where we've been focusing in this area is recharacterization of that interest. So if it's defined as interest, it's going to fall into that 163J limitation. But if you can move it out of the interest bucket and put it into another bucket through a variety of different ways, and we'll talk a little bit about what some of those might look like, you can recharacterize that deduction. So think capitalizing it into a depreciable asset, for example. If you're able to capitalize interest, instead of on the back end when that asset depreciates, you're going to have a depreciation deduction and not an interest deduction. So you'll take it out of the basket that's subject to the 163J limitation, and you'll put it into another category of expense that doesn't face such a harsh limitation. There's a couple opportunities here. We're not going to go through these in any level of detail today, but here's a few that you could consider and where we've been working with clients in this area. There are opportunities. Some of these are through elections, some of these are through method changes, and some of these are through other mechanisms where you can allocate interest expense to some of these activities or property, and the interest expense will lose its character as interest as it's either capitalized or as it becomes part of the other items here that we're talking about, the activity or the intangibles. Ben, anything to add to that before I move on?
Non, ben, juste en fait, peut-être pour revenir un peu sur ce qu'on parlait sur la R&D, le point que je veux vraiment que les gens retiennent sur ce que Keith a mentionné, c'est que la question maintenant qu'on pose souvent à nos clients, as-tu des dépenses de recherche et développement aux États-Unis? La réponse que je reçois toujours, ou souvent, c'est non, parce que je ne réclame pas de crédit. C'est deux choses. Okay? Il n'y a pas. Le 174 vient dire OK, ça, ces dépenses-là devraient être capitalisées. Puis là, on a tout entendu la nuance entre j'ai du risque ou j'en ai pas, puis je possède l'IP ou je le possède pas. OK? On arrive avec des résultats qui sont différents par rapport à comment on répond à cette question-là. On peut arriver à un endroit, puis je sais qu'il y a des clients dans la salle ici qui sont à cet endroit-là, où on va avoir des coûts qui vont devoir être capitalisés à 174, mais qui nécessairement ne créeront pas ce qu'on appelle un Qualified Research Expenditure à 41 qui donne accès à un crédit. Donc, on pourrait être techniquement à un endroit où je dois capitaliser, amortir sur 5 ans ou 15 ans, mais que je n'aurais pas le droit au crédit d'impôt par ailleurs aux États-Unis. Ça, c'est une nuance qui est super importante. Parce que ce n'est pas du fait que j'ai des coûts qui se qualifient à 174 qui automatiquement font que c'est des coûts qui se qualifient à 41 aussi puis qui donnent accès à un crédit. Fait que ça, c'est important. Parce que, ah oui, mais je réclame pas je réclame pas de crédit, ça n'a rien à voir. Deux sections de la loi complètement différentes, qui ont des définitions qui se rejoignent, mais on disait, j'ai un risque financier ou j'ai droit au IP, tandis que pour le crédit, il faut que j'aille les deux. J'ai droit au IP puis j'ai un risque financier aussi. Le concept de funding qu'on appelle aux États-Unis. Pour ce qui est de l'intérêt, pour la recaractérisation, on le fait avec d'autres types de dépenses aussi. Royauté, d'autres trucs qu'on venait sortir en fait d'en dessous de la ligne puis qu'on en remettait dans le cost of goods sold parce que mon cost of goods sold, d'un point de vue US, c'est pas une dépense. Ça pouvait venir avoir des avantages au niveau du beat. Le cost of goods sold n'est pas vu comme une dépense aux États-Unis, mais bien comme une réduction du revenu. Ça ici, c'est un peu la même chose. C'est-à-dire qu'on vient sortir des trucs qui, par ailleurs, seraient de l'intérêt assujettis à 163J. Et on vient les mettre, par exemple, dans un intangible que je vais amortir sur une période de temps qui est plus longue. Et donc, cette dépense d'amortissement-là ne sera pas assujettie à 163J. Et ça se fait, toutes les lignes qu'ils ont ici, là, souvent, c'est des changements de méthode comptable. C'est tous des trucs qui sont, en fait, qui existaient déjà avant que 163J se ramène à 30 % et que devienne un enjeu pour beaucoup de contribuables aux États-Unis. Donc, c'est ce qu'on vient faire ici, c'est utiliser, en fait, des changements de méthode comptable dans mon calcul de revenus imposables aux États-Unis pour faire passer de la dépense d'intérêt ailleurs que de l'intérêt parce que par ailleurs, elle est capitalisée sur un actif, etc. So that's pretty much it.
Excellent. Yeah. So absolutely, we've been well said.
What he said.
Yeah, exactly. We've been having a lot of luck with this area for clients. It has a lot of knock-on effects to your returns. You have to consider what it's going to do elsewhere in the return. So next up, we're going to cover Pillar 2. Monique already gave an excellent overview of what Pillar 2 is, so I'm going to skip that portion of it. And really what I'm going to focus on is what is the impact of Pillar 2 on U.S. companies and what is the outlook? We've hit on this a little bit, but what is the outlook of Pillar 2 potentially being implemented in the United States? So first off, when the Pillar 2 negotiations started in the U.S., a lot had hoped that our GILTI, our Global Intangible Low Taxed Income, which looks something like but not exactly identical to an income inclusion regime that Monique described, we had hoped that our GILTI would either be grandfathered in and treated as an income inclusion regime, or more likely would have been amended in a way that would brought it close enough to an income inclusion regime that we would be considered to have a Pillar 2 regime. It turns out, as time has passed, that neither of those things really transpired. It is not close enough to an income inclusion regime. There's a few notable items on the slide. There's no scope limitation, so it occurs to everybody. There's also no country-by-country limitation. So in the OECD's version, there's jurisdictional blending where you're combining, for example, all your Canadian companies. U.S. GILTI doesn't do that. It combines everything in the world together, right? It has global blending effectively. And those changes are different enough, in addition to the fact that we don't meet the rate, at least yet, until the ratchet up in 2026, that GILTI was not treated as an income inclusion regime. Biden attempted to implement through a Build Back Better bill in 2022 that would have included most, if not all, of the changes and some tweaks to GILTI to hopefully get it there. That bill did not go through. And so what we're left with in the U.S. is no current bill that's in play that would pass GILTI, particularly not for 2024, but no foreseeable bill in the future. And we're left with a GILTI tax that is not treated as a qualifying IIR. We'll talk a little bit later about what GILTI is. It's treated as a CFC tax, so it still does interplay with the system, but it's not going to act in the way that I think many in the U.S. had hoped. There's a few reasons I think it went south in the U.S. It has a little bit to do with the way our system operates generally. The executive branch deals with foreign governments and does a lot of our negotiations. and the House and Senate is what legislates. And those are two different distinct divisions of government. So we have one, the executive branch, going out and negotiating the terms on behalf of the United States, but then requiring the House and the Senate to pass that legislation. That is a challenge, and various members of the tax committees particularly in the House, have been concerned that they're not involved enough or consulted on with relation to the negotiations. There was a Pillar 1 hearing last week where not just Republicans but Democrats were also critical of the negotiations that have transpired and how they have resulted in a system that may be less favorable than they desired for the United States. So we will see where it goes. I hit the 2026 year, right? If we're going to get any type of Pillar 2 legislation in the US, it will be 2026. That's when all the rates expire. That's when there's potential for real tax reform. And on top of that, the OECD, I think this was probably negotiated intentionally, but the OECD has some safe harbors. There's one, for example, if you have a UTPR, you can defer that if you meet a safe harbor if your effective rate is above 20%, excuse me. In the United States is 21%. So you can defer until 2026. So I think they negotiated some legroom where they could sort of hit the pause button and maybe pick it back up when there's a better opportunity for legislation. So this is just an example of how it may apply to a US structure. At least initially, because the US parent doesn't have a Pillar 2 regime, you'd think, well, maybe it wouldn't apply in 2023, but where it's going, or 2024, where it's going to apply is where we have a foreign subsidiary holding company that has implemented a Pillar 2. So take Netherlands, for example, or any other country that has implemented Pillar 2. If you have a US parent that has a foreign sub that's in an OECD compliant jurisdiction that has a low tax subsidiary of its own, it's going to apply at that intermediary parent level. And that's where the US is really getting hit at this point. Those taxes at the foreign sub that are imposed under the income inclusion regime would not be taxable in the United States, or not be creditable, excuse me, not be creditable as a foreign tax credit in the United States. So there's potential for double taxation as a result of this. And it's going to be a real challenge for U.S. multinationals, because had they implemented Pillar 2 at the U.S. parent level, it would have turned off the foreign sub system, and there would be no Pillar 2 imposed at the lower level. Fast forward to 2025, when the UTPR is on, that foreign sub of the U.S. parent would not only tax the low tax foreign sub below under the income inclusion regime, but would also tax to the side the brother-sister company under the undertaxed profit rule that Monique described. So both of those earnings may be taxed in this U.S. parent group by the foreign sub if they're undertaxed, and that tax would not be creditable to offset U.S. tax. Now, GILTI would push down to those subsidiaries when doing the calculation. I'm not going to go through this. There's a fairly complex calculation that the OECD came out with, but they allow you to push down the GILTI tax to your foreign subsidiaries. So in this example, if A is a holding company and B, C, D, and E are all subsidiaries, A would impose, if it was an implementing jurisdiction, would impose an income inclusion regime potentially on B, C, D, and E if they were undertaxed. Any U.S. GILTI tax at the USP level would be pushed down to B, C, D, and E. It's a very mechanical calculation. It's only, coincidentally, once again, until 2026, so it's a transitional rule. But during that time, you can push down those GILTI taxes to treat them as taxes of that jurisdiction when calculating your effective rate, to figure out whether you're above or below the 15% and whether you have a top-up tax. The mechanics of the calculation are quite favorable. They generally push to the low tax jurisdictions, just the way it operates. So if you have GILTI and you are in a situation where you have a stacked structure, you'll have to go through this exercise in 2024 to push down that GILTI tax. There's very little guidance right now as to how the U.S. system is going to interact with the Pillar 2 system. This is all we have at this point. It's Notice 2023-80, and it addresses the mechanics of Pillar 2 and how certain aspects of those mechanics interact with the U.S. taxation system. They primarily address two items: creditability and dual consolidated losses. In the creditability space, they came out and said, if it's an income inclusion regime tax and it's part of an ultimate parent group and there's a tax imposed, the US will not view that as a creditable foreign income tax, and they'll deny you a credit. They also deny you a deduction, so you can't get a credit or a deduction for those taxes paid. It's very unusual in the US to do that. They had to do that because of the way the system works, because the income inclusion regime is reduced for the GILTI tax. If the GILTI tax is then reduced for the income inclusion regime, either by a deduction or a credit, you have this circular reference, and it becomes an iterative calculation, and you can't really solve for two variables. So they had to disallow not just the credit, but also the deduction to prevent that circularity that was in the system, with both taxes sort of relying on the other one. They also dealt with DCLs. I'm not going to get into those. Those are very complex rules, but they provided some favorable transitions. And DCLs are double dip rules. If you're trying to take losses in two jurisdictions, the DCL rules will prevent that. There's loss sharing just inherent in Pillar 2, right, in the jurisdictional blending. So they provided some guidance there in a short-term sort of transitional overview. All right. So we're going to talk a little bit about some outbound rules and how they might interact with Canada. Just going to give a little update on the foreign tax credit rules, because a lot changed over the past year in that area, and then talk about some particular aspects related to Canada specifically. So the foreign tax credit rules had a little bit of a roller coaster ride over the past 2 years. The US's original foreign tax credit rules that focused on determining what is an income tax and thus eligible for a foreign tax credit were written in the 1980s. They were very much out of date. They didn't deal with digital service taxes, Pillar 2, or anything in between. And so they were in much need of a modernization. The IRS and Treasury went through a lot of effort. They modernized the rules. They released these new rules that were proposed. They finalized those in 2022, and they came online in 2022. And those rules went from a sort of generic, it has to be a tax in a US sense, an income tax, and it was a very subjective test, to a very rules-based driven test where you had to meet like 4 components. And if you didn't meet one of those components, the entire country's tax was non-creditable. It hit a lot of countries that a lot of people didn't think it was going to hit. Germany, for example. A lot of people thought the German tax was non-creditable for a period of time. And the IRS and Treasury realized that there were some issues with these rules, and they slowly walked those rules back over the course of the past 2 years or so. They amended the rules. They put out some proposed regs that clarified that the German tax, the trade tax, was creditable. They provided some exceptions for royalty withholding, which was largely non-creditable under these rules. And then mid through last year, they just completely paused the rules. And they said there's a 1-year deferral. We're not going to apply these rules from their effective date forward. They then, at the end of last year, extended that effectively almost indefinitely, where they paused those rules and said, now these rules aren't going to apply until we've had a chance to modify them. And they're going to be permanently suspended until we've said that they're back on. So effectively what they did is they made a lot of effort. They changed the rules completely. There was massive financial statements adjustment as a result of this. And then they kind of hit the undo button and winded it back and effectively said, the old rules that applied before we did all this are the rules that will continue to apply until we say otherwise. So it was a big challenge for taxpayers. Certainly, you're not going to have to follow those rules for 2024. If you had been analyzing them, a lot of companies were getting studies and some of their credits were no longer creditable. Effectively, you can go back to the old rules, at least until they've had time to work all that out. The one exception to that is digital service taxes. So they rolled it back for everything except for DSTs. The US is not fond of DSTs. They are in support of a moratorium on DSTs until Pillar 1 progresses. And so they did keep keep regulations in that said digital services taxes are not creditable. All right, so we're going to talk about a specific item related to the GILTI high tax selection and refundable credits. This was in that original tax package, and it may have direct relevance to Canadian CFCs. So just to sort of set the stage for this one, the GILTI high tax election, in our system, the GILTI, you calculate all your earnings, right? You bring it up and you subject it to a tax. There's an election you can make to exclude some of those earnings from being brought up into that calculation if it's subject to a sufficiently high level of tax. That's 90% of the maximum rate in the US, which is 90% of 21%, or 18.9. The policy behind this is if it's already subject to a high level of tax, you're not going to pay much guilty. There's no point in necessarily going through all of the effort. So they allowed this election where if your effective rate is above that 18.9%, you can exclude this income from the calculation. Very helpful for example, U.S. multinational that only has a sub in Canada. It would, if they had a high tax sub, 18.9 or above, which we have a lot of clients in that situation, they would just be able to not have to do the entire GILTI calculation effectively because it would be excluded income. Or they wouldn't have to bring it into the U.S. and take a foreign tax credit, I should say. The calculation works off the U.S. rules. You have a numerator that is a creditable foreign tax under U.S. rules, a denominator that is effectively the taxable income for all intents and purposes, the pre-tax taxable income of that entity. So as a result of some recent developments, relatively recent in the past 2 years, the U.S. has changed its view on how it's going to treat refundable credits for purposes of this calculation, and in particular that numerator. When I said it was the creditable foreign taxes that was in the numerator, previous administrative guidance had said that any refundable credit would effectively be treated as constructive receipt of cash and then payment of tax. So if you had a refundable tax credit, a local credit, like a refundable Canadian credit, for example, that reduced Canadian tax, if it was refundable, you could treat that as if the Canadian government gave you cash and you gave that cash back to pay your tax. And so you could treat it as a tax paid. They modified that rule pretty significantly, and now it has to be available as cash. They have to elect to take cash, and it can't be first applied against the tax. So they can't automatically apply it against the tax and only refund you once the tax is paid. It has to be available for cash. And if it's not available for cash, it's no longer treated as a refundable credit for this purpose, which means instead of treating it as a constructive receipt of cash and a payment of tax, it's just treated as a reduction of that tax paid. So we have an example here where we can see the old rules where we had a refundable credit, but it was first applied against tax before it was refunded. And you can see you're eligible for the high tax, $25, well above the 18.9%. On the right, with the change in those rules, you can no longer count that as a creditable foreign income tax, so your numerator goes to 0, and now you don't have a high tax entity, and you may not even have a credit in the United States in this instance. And Ben, I think there's some Canadian credits that might run afoul of this.
Oui, multimédia, ce genre de trucs-là, ça c'est où qu'il y a une portion qui est remboursable. Le traitement a vraiment changé. C'est-à-dire que, comme Cory disait avant, même si la portion était remboursable, on l'incluait au revenu, puis ensuite on diminuait notre impôt, mais ça venait jouer sur notre taux. Fait qu'on pouvait souvent rester en haut, par exemple, de 18,9 %, puis on avait un high tax kick-out election. Là, maintenant, ici, on ne fait plus l'inclusion au niveau du revenu, mais on vient diminuer l'impôt quand même. Donc là, dans l'exemple ici, on se ramène à 0. Il n'y a plus de high tax kick-out election, et en fait, il y a un guilty là, qui est applicable. Donc, juste où sur la ligne on met le crédit qui est remboursable, ça peut avoir un impact qui est quand même majeur. Là. Puis vous allez le voir si, par exemple, multinationale américaine qui a une société canadienne, puis qui a des crédits multimédia, une portion du crédit qui est remboursable, ça va avoir un impact, là, clairement.
Okay, so we're going to close out with IRS enforcement trends. Just got a couple more minutes. We're going to hit some of the direction and give you some insights into what we're seeing as far as IRS examinations have gone. So just to set the stage here, what we had seen in the United States as far as examination is almost none, to be honest. They had a very limited budget that had declined significantly over the years. There was very few exams. There was COVID-19, which further caused delay and issues. Then we fast forward to 2022, 2023 timeframe. They received $80 billion, which was subsequently reduced to $60 billion in funding. So they have a significant increase in funding as far as enforcement goes. and they are hiring significantly. They're also investing in AI and other ways to identify taxpayers to audit. So you can see here, these are just the trend numbers for the past 10 years or 10 years prior to 2020, where you can see exams already low went down to almost non-existent by the end. You look at the partnership, for example, when it was less than 1%, and it's almost zero at this point. And this illustrates that. Out of the 4.6 million partnership returns filed in, I believe this is 2019, 3,269 of them were selected for audit. That's 0.027. Basically, no one's getting audited is what the situation was in the past. That's changing a little bit due to a couple different trends. There's legislation, in particular around partnership audits, where they can now collect the tax from the partnership and they can do push-out adjustments to the owners. And there's different ways they can do it in a much more easy fashion. They're doing data analytics and campaigns, and they're hiring significantly. So you can see that the funding was cut from 80 to 60, but they've already received $45 billion of that. And their goal is to close the tax gap. They expect they can get $200 billion a year out of a $600 annual tax gap of tax that they believe they owed that are not receiving. And they've really ramped up with 87,000 potential new employees that they're looking to hire over a short period of time. So what does that mean? It's likely to mean a significant increase, and it already has honestly meant a significant increase in examinations in the United States. We're seeing clients under exam much more frequently. We're finding very targeted exams. For one, for example, there's a campaign on inbound distributors where foreign companies sell into the US. They have a campaign addressing whether that distributor is fairly paid through the transfer pricing rules. And they're doing different items, like they're sending soft letters. We have dozens of clients that have received soft letters. They're opening up exams. They're being much more targeted, direct, and intentional about it. And they have a lot more funding, so they're doing it much more frequently. How are we doing on time, Ben?
I don't know. What is it saying there?
When do we end? 16:53.
At 5, I think.
Okay.
Yeah.
Keith, do you want to hit the research campaign?
Yeah, so we hit on this in terms of when I talked about kind of level of effort. So, part of it was the additional documentation required to be filed with refund claims. That's kind of part of the campaign of proposing the form that would include similar type of documentation that would be attached to the return. In other words, documenting why all your projects qualify, providing a list of employees, what services those employees are providing. So it's that campaign that's really driving the level of effort that it takes to report, comply, and then ultimately on the back end, we definitely are seeing an increase in IRS examinations around the R&D credit in particular.
Yeah, absolutely. And something that's a little bit different that we're seeing more recently is the type of professionals involved in the exams. For example, in withholding tax exams, they're now involving the foreign payment practice, which are higher level specialists in the withholding area in the exams. In international tax, we're seeing hirings of higher level, more senior professionals. Whereas in the past, when we had international tax exams, we might have a general examiner who's familiar with federal tax, but really has no familiarity with international tax whatsoever. So it caused challenges on both sides, honestly, as to how to work those exams through. We're certainly seeing a lot more higher of level resources that they're going after than they may have in the past. Couple court cases, I'm not going to cover all of these, but the IRS has had a number of wins as well in a variety of spaces. These ones on the slide here are transfer pricing. There's been quite a few very significant and very material transfer pricing wins that the government has had over the past 3 years. And these are big numbers. Coca-Cola with 1.8 billion or 9 billion, excuse me. Medtronic was another 1.4 billion, 3M 27 million. So just large wins for the IRS in a variety of areas, some dealing with blocked income, others dealing with how foreign subsidiaries are compensated through an arm's length arrangement. And these are really a first for the IRS. They haven't had any real success, to be honest, in the courts with transfer pricing cases for probably 2 decades or more. And now we're starting to see some pretty significant IRS wins in the transfer pricing space. So what does this mean? It likely means that this is going to, as with the distributor campaign that I mentioned, a more heavy focus on international exams, on transfer pricing, and making sure that the U.S. is properly compensated for whatever it's contributing to the overall business organization. If what we're working with clients right now is how to prepare for those types of things. There's a few things you can do proactively because we expect to see a lot of exams in this area over the course of the next 2 years. That's refreshing transfer pricing reports, considering APAs in some cases. Those are the bilateral agreements that lock in the prices, and make sure you have the right contracts in place, and that there's proper compensation for all of the cross-border payments. That will set the stage if an exam were to be open, that you'll have the right documentation and be able to kind of proactively address those types of items. So I think that closes me out. Ben, I don't know if you want to have anything to add to that.
Good.
All right. Well, thank you, everybody. Appreciate your time.
Thank you all.